be here to talk to you about the whole farm revenue coverage. The Whole Farm Revenue Protection Program was introduced with the 2014 Farm Bill, and it replaces the Adjusted Gross Revenue and AGR Light programs. This program should now be available in all counties across the U.S. This program is a revenue-based product. Typically, the revenue-based insurance policies by the federal government has always been for like corn, soybean, the wheat, all those major commodities that were produced had revenue policies, and we never really had a product or a risk management tool for our specialty crops. There were a few of the crops that had specific multi-peril policies for them, but this is the first time that we've actually had a whole farm type protection that will cover all the revenue that you receive for your crops that you grow on your farm in one single policy. And with this policy, think of it as an umbrella policy that you're able to have a revenue trigger, and if you fall below that trigger, you're going to be paid an indemnity. So what crops can we not cover on this? Well, we can't cover crops that are timber or forest products, animals that are raised for sports, show, or pets, and also any federal illegal crops. Now, the key word there is federal here in Oregon, so unfortunately we cannot cover cannabis under this. The other causes of loss that we're covering here is unavoidable natural causes of loss that occur to your crops in any given year. So anything that would potentially cause a reduction in your yield could be a covered cause of loss, because a reduced yield is going to reduce your revenue. Also, we're covering the market price decline, any kind of fluctuation of market prices. So if there's an oversupply, where it's been a really good growing year and the price drops because there's just overproduction, this could also be able to fall in. But we're looking at the overall revenue that you gather, even though you may have overproduced and the price dropped, but you're able to make up that because you have a higher yield. The only thing that we can't cover is any kind of man-made type of cause of loss. So if there's a quarantine that's placed on your crop, then that would not be covered. But let's say, for instance, SWD comes in, that's a pest, and your crop is refused. Well, that's still a natural cause of loss and would be covered under this case. How do we build this policy? Well, we build this policy by using 5 years of tax history, and we set an average based off of those 5 years. In this instance, we're looking at for 2016, and we're going to skip 2015 because many people are just filing their taxes at this point. And so we're using these 5 years. Notice in this 5-year history here that we have an increase in income, and we're able to account for that because we're able to use an index factor. So any kind of growing operation, or if you're reaching peak yields on your blueberries, we would be able to account for that. We can also account for an expansion of the farm. So if you're picking up more ground to farm, we can use an expanded operation value up to 35% greater than your average to account for that expansion. The other side of the coin is that we have to look at your approved expenses. So we're looking at the expenses that are generated from your inputs to growing that crop, and that will also be averaged out and indexed over those 5 years. One allowance for young and beginning farmers is that we reduce that to 3 years for an average, so it makes it a little bit more acceptable for small and beginning farmers. We're going to compare that historical average to what you intend to grow for the coming year. The farmer will set his yield for these two crops. We're going to use this as our example. And he also sets the expected value for those crops. And you must be able to substantiate this with either historical or common growth patterns for your farm. And also, this is the power of this policy where you're setting the value for the crops For instance, you might have a special market, or you might be selling fresh, where the typical crop insurance policies, those values are set for you. Your total expected in this instance is going to be 1.8 million. We'll compare that back to the historical average. If you qualify for index, we'll compare it to it, and the lower one will set your approved revenue. So we have a whole farm revenue value set, or approved revenue. Your next step as a grower is to elect your coverage level, and this will set our income trigger for depending on which level of coverage. Now we can go as high as 80 and 85%, but you must grow at least 3 crops that contribute to that income significantly to be able to qualify for those coverage levels. If you take the 1.8 million times the 75%, you get the income trigger at 1.35 million. Again, we're going to look at the expenses to make sure that you're following your inputs, and you must occur at least 70% of your allowable expenses. If you fall below that 591,000, they will reduce your approved revenue, which effectively reduces your income trigger. So the important points that you want to remember on this is you got to know where that income trigger is at. If you fall below that income trigger, that's what triggers your indemnity. The policy is going to come in and replace that income that you've fallen below that income trigger. You must meet your expenses. You must have that expense trigger met. And if you don't, again, they reduce that approved revenue. What does this cost? Well, typically, in this case, is about 1.4% of the whole farm revenue. You may say, well, that's pretty inexpensive. Well, it's because it's highly subsidized. Important factors that you may want to consider when you're making your WFRP decision, and that is what is your approved revenue? That sets the point that everything else is based off of. What is your income trigger? You're going to be able to adjust that based on what coverage level that you select. Expense trigger. Got to know that if you're going to be able to meet those expenses, for instance, if you're in strawberries, hand harvest, very expensive, and you don't have a crop, you may drop below that trigger, but it's not going to necessarily kick you out of a claim. But the policy is not designed to, if your money not out of pocket, it's not going to turn around and re-indemnify you for that reduced expense. What is it going to usually cost? Well, typically I've seen that the cost is usually about 1 to 3% of your approved revenue. So I said this was highly subsidized, and if you grow at least 2 crops, you qualify for an 80% subsidy all the way up to 75%. Notice that the subsidy drops off quite rapidly at the 80 and 85%. If you only grow a single crop, you don't qualify for that higher subsidy. The subsidies are still substantial that make the product very affordable. One thing they did with the 2014 Farm Bill was that they tied or linked a conservation compliance to your subsidy. Doesn't mean that you can't get crop insurance, that if you're not in compliance, you can still do that. You're just not going to receive any subsidy. But you must have this AD 1026 on file with the Farm Service Agency by June 1st prior to signing up for this coverage. So if you're looking at this coverage in 2017, you would have to have this on file by June 1st. So I highly encourage you to check with your Farm Service Agency to make sure that you've filed your AD 1026. How are claims settled? Well, claims can't be settled until the taxes are filed for the insurance year. As you're going through your crop year, if you suffer any kind of damage to your crops, you do have a responsibility to report that damage. Or if you change your crops, remove a crop and replace it with something else, any kind of changes like that, you need to notify your agent within 72 hours. Once we get around and you file your taxes, the adjuster will be able to begin settling the claim. Any revenue that you receive from crops that were grown in prior years that you've carried over into this tax year, they'll exclude that revenue. But at the back end, any crops that you are carrying forward into the next tax year, they'll add back in. So in financial terms, we're taking it from a cash basis to accrual basis to settle a claim. You need to also count if you have any individual multi-peril policies on crops there, any claim payments that you receive on that will also count as revenue to account. So for example, if our revenue trigger was $1.35 million and you only had revenue off those crops that you harvested in your tax year, the payment would be $350,000. This was a big change. They went from a net payment rate to 100% payment rate with this whole farm revenue. So when your coverage begins, well, the coverage begins when you sign up with your application to the company and meeting with your agent, completing all your application. We need your tax information. You need to complete the application. We need an inventory of your crops that you're carrying forward and any accounts receivable that's moving into the next tax year. And that means 10 days after coverage would begin. If you're a calendar year filer, you'd want to start this process in late December to make sure that you're going to get your coverage to start at the beginning of your tax year. If you're a fiscal filer and the tax year doesn't begin until July 1st, your policy is not going to begin until July. Sales closing date is March 15th. So if you end up signing up just in the 1st of March, your coverage is not going to start until 10 days after that. And if you were a calendar year filer, you've already missed out on 2 years there. When is this billed? Well, it's not billed up front, so your premium's not due until August 15th. But there is an exception for those people who are late fiscal filers, say in October or November. You do not have your premium due until December 1st. If you have 30 days to pay that, after 30 days, they do charge interest. So this has been a brief overview of the whole farm revenue policy. And if you have any questions, feel free to give me a call or make a contact.
If you enjoyed this webinar and support this kind of work, check out our website and consider supporting us for future such efforts.